Welcome to the LiveSquawk podcast, where professional traders, investors, and market insiders get the unfiltered insights that matter most. Stay ahead of the curve with expert interviews and exclusive market commentary.
Before we dive in, if you want the news that moves markets delivered in real time, 24 hours a day, check out LiveSquawk. It's our audio squawk service trusted by serious traders worldwide. Start your free trial today at livesquawk.com. No credit card required. Hello and welcome to LiveSquawk's Market Talk on Tuesday, 28th of April, 2026. On this episode, we'll be previewing the April FOMC rate decision due in about 24 hours from now, just over 24 hours actually. We're doing this on a Tuesday rather than on a Wednesday. On this episode, we'll be, as I said, previewing the FOMC rate decision. We'll have a look at Canada, but only in the general sense. We do have a number of rate decisions this week. The announcement on Wednesday will come at 1400 Eastern Time, 1800 GMT, and then 30 minutes later, we'll get the press conference, the last scheduled press conference from current Fed Chairman Jerome Powell. To help me work my way through and make sense of all this, I'm joined by some very knowledgeable and respected guests. Firstly, a warm welcome to regular contributor Joseph Choi, author of popular market blog, The Curve Advisor. And we're joined by David Rosenberg, founder and president of Rosenberg Research and Associates, an economic consulting firm he established back in January 2020 after an illustrious 3-decade career on Wall Street and Bay Street as an economist and market strategist. So a warm welcome to you both. We'll come to you guys in a second, but with the niceties out of the way, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. LiveSquawk is not licensed financial advisor, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any market decision or investment decision. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Okay, I'll start with a quick overview of what we're looking for today. Bear with me when I get the notes up on that. And this is from Barclays. They say we expect the FOMC to hold rates steady, given elevated uncertainty about inflation and employment, and to signal an extended pause. We still expect the FOMC to cut rates by 25 basis points this year amid moderating crude oil prices and core PCE inflation. However, risks are tilted toward higher inflation and a delayed rate cut. Those are comments there from Barclays. We'll look into some of the other aspects of this as well. Rates are currently at 3.5% to 3.75%, and where they're expected to stay, as I said. But really, there are a number of moving parts to this month's decision. As I said, it's the scheduled last number for last meeting. From for Fed Jerome Powell, Fed Chair Jerome Powell, and then the next meeting we should hopefully have new Fed Chairman Kevin Walsh in the hot seat. But it's set against a backdrop today of the ongoing energy crisis that we've seen for the last sort of 6-7 weeks now. And although there's a cessation of the fighting, we are still really focused on the fact that we're not seeing a lot of or any transportation of energy from the region as such. And the spillover effects are starting to be seen in some of the data out around the major economies at the moment. So we want to focus really on the Fed reaction, market reaction to that, and where we go from here. So I want to bring in, was David on this one in the first instance. Then, what are your initial views on what we're likely to see today, David, and how they're likely to be governed or affected by the energy situation at the moment and the general geopolitical situation?
Right. Well, first, thanks for having me on the call.
Always a pleasure.
The easy forecast is, of course, no change in rates. And so what will impact the markets will be the tone of the press statement and then what Powell has to say at the at the press scrum, although arguably is lame duck at this point. So probably more important if we had Kevin Warsh up there instead. But all that said, there's no way that the Fed, whether it's the press statement or the press conference, because it's going to sound dovish. The question is, how hawkish will they sound? And my sense is that they're still humbled and hamstrung by blowing the transitory inflation call after COVID and with all the stimulus. So I think that at the margin, there's going to be more commentary on inflation risks. I think that they seem collectively to believe that the economy is in fine shape. In the past, when he tried to sound dovish, Powell would talk about, the tension between the labor market and the inflation backdrop. I think that after the last set of data we got from ADP and from the non-farm pay report, if you believe these numbers, and they seem to, notwithstanding the fact they get revised so substantially, I think that for the Fed to start sounding dovish again with the inflation outlook so muddled, um, we're probably going to have to see non-farm payroll start to contract, not even just flatten or come in below expectations.
Okay.
So for the near term, I'm leaning towards the Fed to line up more on the hawkish than dovish side if we're going to sort of try to draw the probability map.
In terms of, I mean, I was talking to a couple of traders about this, and it is like you say, it's more the level of hawkishness as opposed to whether that's even a two-way conversation about dovish or hawkish. Joseph, as a trader, you trade interest rates. How will you face up to tomorrow's decision?
Oh, well, there are a few things I'm going to be looking at. So the first is whether the Fed's going to change to a neutral bias from the easing bias that they currently have in the statement. Nick Timoreos from the Wall Street Journal was out with a piece suggesting that they could change to a neutral bias. So I'm not sure if that's just based on some inside information that he has or he's just speculating. But it will be interesting whether uh, the Fed conveys their hawkishness through the statement and or through the press conference. One thing about the press conference related to to being hawkish is, from a game theory perspective, if you know the next Fed chair is going to be dovish and you want to balance inflation expect.
I think we lost Joe there briefly. Um, Sorry, just until we can get him back here. I wanted to maybe understand what monetary policy can do in itself. You know, with these external shocks that we're seeing at the moment, David, how much can the Fed, even in its wording, mitigate what we're seeing at the moment, or is that not the point? It's just to try and keep a level of confidence that, as and when things really turn for the worse, if they do indeed turn for the worse, it can, it can be relied upon.
Well, that's a great question. Well, I mean, unless somehow the Fed can replace Kushner and Wickoff and negotiate some deal with Tehran, there's not much the Fed can really do to mitigate supply shocks. The Fed really can just influence the demand side of the economy.
Hmm.
I think that the operative word you use was confidence. What they have to do is maximize their credibility.
Okay.
So they certainly can't let the markets think that they're going to take their eye off the inflation ball, especially in light of what happened 4 and 5 years ago. Their big concern is this, and this is what happened back in 2022 and 2023. If it was just the supply chain effect from COVID, inflation would have peaked out at 4.5%. But we got to 9% because it fed into wages.
Right.
And we ended up having unexpectedly just a raging strengthening in the labor market. A huge mismatch. Of course, people were getting paid not to work back then, and there was $2
Mhm.
trillion of pandemic stimulus checks. People didn't have to work, so companies had to dole out more money to bring people back into the workforce. The quit rate was jumping, lots of job hoppers. It was really a seller's market for labor for a period of about 18 months. So the Fed's primary concern, and of course, that's how we got to 9%. We got to 9% instead of peaking at 4.5 because of the second round impact that supply shock had on the labor market. So the Fed may well switch to their neutral bias. They've been talking about that for the past several meetings, but for them to actually raise rates,
Mm.
it would have to morph into wages. They'd have to see signs that inflation expectations are on the rise, and they'd have to see a wage response, which hasn't happened yet, but still early days.
Yeah.
So that's really first and foremost the Fed's nightmare
Mm.
scenario is that the price shock moves into the wage cycle, and that's how you can get a spiral like we had a few years ago.
Okay. Um, it was interesting what you said about trusting the data we're seeing because of the revisions. Obviously, we saw the March reading coming out was 178,000 from expected 65,000 job gains. But we did see a tick down, I think, in the unemployment rate. The feeding into this data at the moment, is that what you're mistrustful of at the moment? The fact that you know what's being put into the data at the moment in terms of survey and whatever it is that they're collating just isn't accurate enough right now, or are we in that dynamic a market at the moment, a labour market, whereby these things are changing so rapidly?
Well, the revisions from the first estimate to the final and third estimate have just been absolutely wild and consistently to the downside.
Right.
Point number one. Point number two is, yeah, the U3 unemployment rate, which you referenced, is not something I'd be looking at if I was at the Fed. I'd be looking at the broader U6,
Okay.
which gives you more of an indication as to what the overall slack is in the labor market. And that unemployment rate actually, went up in the last report. And the wage number was very tame.
Mm.
And you're seeing this. It's the most unusual labor market I've seen in my 40 years in the business. Of course, they call it the no hire, no fire cycle. And you can see that the traditional metrics of labor demand, they're going down like a hot knife through butter. And the reason why we haven't seen steady a steady diet of declines in non-farm payrolls is because the firing rate has been so low.
Okay.
And the question is going to be, when do those two lines cross and we start seeing sustained declines in non-farm payrolls? Now, my big concern, as far as the Fed's concerned, is that many of them believe that the break even is almost at zero. So think about that you actually not just have to see employment flatten, you probably have to see it decline to get the legion of Fed hawks to start to scream uncle and say, okay, you know what? Perhaps the next move is going to be a cut. It's
Yeah.
going to come down more to the labor market because even if we get some kumbaya moment in the Strait of Hormuz, it's going to take many, many months before things get restored.
Mm.
And that you get relief on the energy price side. And then don't forget, energy feeds into a lot of other parts of pricing, including things that are in the core, like airlines and delivery services. So I think that it's more likely that we're going to get more serious erosion on the employment side. Employment growth on a trend basis has slowed dramatically. I mean, it is almost flat as it is on a year-over-year basis when you look through the monthly wiggles.
Right.
But if you're a dove or a bond bull, in this inflation climate, which I think is going to be persistent at least through the summer, um, for the Fed to start sounding dovish again,
Mm.
they're going to have to see signs of some serious cracks emerging in the labor market.
So you don't think demand destruction is enough in the sense that, as you mentioned, the spillover and the second round effects we're likely to see, or secondary effects we're likely to see in everything. Um, you don't think there's a danger down like this hits productivity to enough of a degree to worry the Fed? You think it's all on the labor side of the fence really, and how they view wages? If I'm being,
Well,
if I'm simplifying what you're saying.
yeah, I mean, you have to look at the productivity side through a long-term lens.
Yeah.
I mean, you do get, quarterly movements. If you looked at just the last couple of years, productivity has been very impressive. In fact, in the past 2 years, productivity has accounted for 92% of the growth in the economy. Labor input has been
It's
a
enormous.
two-bit player. In a normal year, it's split 50-50, labor input, productivity, in terms of what's generating economic growth. Even when you go back historically and you look at other shifts, major shifts in the technology curve, it's like 70% productivity, 30% labor. We've never seen this before. 92% productivity. So it's all productivity. And I would tend to agree with you. This is, I think, where Kevin Morse lines up,
Mm.
is that if you're looking at it from 30,000 feet up in the air and, okay, we're going to get some energy related inflation. The question is, how transitory is that going to be? Uh, how do you really square the circle on a inflation view when productivity is so dominant? And productivity, of course, depresses labor costs, which is the mother's milk for
Yeah.
inflation. Not energy, not commodities. Labor costs have the highest, most significant coefficient in any inflation model. But as I said before, the Fed is run by humans, not by robots. They are collectively shamed by missing the transitory 4 years ago. That hasn't been lost on them. So, fool me once, shame on you. Fool me twice, shame on me. And that's where the mindset of the Fed is. I'm for sure 100% convinced if we didn't live through that miserable memory of what happened when inflation in short order went from 0 to 9%, that the Fed would be, I'd say, even more dovish than they are. And they look through this. Don't forget that in Gulf War One,
Mm.
which started in August 1990, Operation Desert Shield morphed into Desert Storm. That started in August 1990. I don't even know if any of the listeners even would remember this or if they were born in that period. And of course, it ended in February 1991. Oil prices more than doubled. They went from $15 a barrel to 40. We actually had a recession, which not even the Fed thought we were going to have. Now,
Yeah.
you go back to July, August 1990, Greenspan at the FOMC meeting, when you look at the transcripts, told the committee that he doesn't see any recession coming down the pike. And yet it had already started when he made that statement, notwithstanding the fact that the Fed still at that point had a rosy scenario for the economy. And understanding that we had an inflation shock, Greenspan, through that whole piece of that Gulf War One, cut rates 5 times. But he
Well,
wasn't saddled. You see, you used the word confidence. He at that point was on the road to becoming the maestro. He did not suffer from a credibility or confidence standpoint. And by cutting rates 5 times, he prevented the recession that we had from getting even worse in
yeah.
1991. But then again, I think Greenspan, despite all his faults, and we could blame him for, and Bernanke shares in that blame for the bubble that we saw,
Yeah.
in the early 2000s. He was a terrific economist. I mean, he was fantastic. He cut rates 5 times. Like, I'm still in the camp they'll be cutting. We're just talking here about the upcoming meeting
Yes.
and what
The very next
that
one.
function is going to be, maybe for the next few meetings. But I still think, and I think they'll be cutting rates more than once. But my assumption is that the cracks are forming in the labor market. They haven't come into full view yet. I
Mm.
understand what it is the Fed's looking at. If once we start to see a sequence of negatives on non-farm payrolls, there's no doubt in my mind that they'll be cutting rates, and it'll be more than just one move.
Very interesting. On that note, we've got Joe here again, interest rate trader. I know you said we were looking for them to try and maybe message a neutral stance for the time being. But as a rates trader, and you're looking at not just this meeting, you're looking down the line. You trade futures. You look at um, you know September onwards, and so forth. Where do you position yourself at the moment, or do you not want to because of the situation we have in the Gulf at the moment? You want to keep it. You want to keep it fluid. From a trading perspective, how do you view things?
Oh, yeah. I think because we're so headline based right now, it's very difficult to trade anything, 1 year and in. And so most of what I do is just been further out the curve, just playing I think in the short term, things could look a little worse before they look better. Um, and by worse, I mean, inflation could start looking high, because I guess it has been my contention that Iran might be stalling. It's going to be very difficult with the sides the way they are to get them to talk and then, to make quick progress. And then the other thing that I guess I have on the back of my mind is that I think the World Cup will actually give a temporary reprieve to any weakness in the economy. So, I think that's going to be an upside risk to inflation as well, a further upside risk to inflation on top of everything else. And then I think that could cause, a bit of an economic boost, because the scope of this World Cup is just so large. But just kind of getting back to oil, I also think it's going to take a while for second order effects from any oil related disruptions to kick in. So, for example, whether it's the jet fuel, the fertilizer, or whatever, I mean, not only do we need to see some sort of peace in the Middle East or some sort of a resumption of exports, but it's going to take a while for countries to reestablish production. It's going to take a while for countries to get ships out. And so, so like David was saying, I don't think this is going to be like a 1 month story. I think, for at least the next few meetings, the Fed's just going to be looking at hawkish data. And so, but mostly I'm kind of staying clear because there's quite a bit of headline risk. And the thing with being a trader, trading a product that's a zero sum game, in an environment where there's obviously some insider trading going on, is that if there are people in the market taking large chunks of P&L out of the market in a zero sum game, that's negative for me. And so I'm just adjusting accordingly by just sticking to the parts of the curve that won't get too distressed on headlines.
It's an interesting point from a trader there. And, we could do another episode on what we think's going on behind the scenes in the in the markets at the moment. We are seeing these outsized moves, and then we're seeing potentially comments coming. Well, we have seen comments come from officials that have then borne out the direction of that move, but that's speculative at best at the moment. So we'll stick to what the facts. I do want to come back to stick with the markets though, and the equity markets that we've seen seemingly. I mean, I don't know. Some say complacency is there. Others suggest that they've factored in everything and still like the upside. And there's still some bullishness. Obviously, we've got quarterly earnings season. We haven't seen anything that startling in the forecasts that are being produced and the commentary from the heads of these titans of industry, if you like, the banking sector predominantly. I know that JP Morgan's Jamie Dimon's generally a cautious person when he speaks, but there's been nothing that sounded the sort of klaxon as such. David, I've seen a piece from you. You put a piece out on the 17th of April that said the market is pricing in a return to normal while ignoring the rolling contagion about to hit from the unprecedented disruption to global energy supplies, as you've touched on today. The S&P 500 is a price to sales ratio at 3.5 times, nearly 3 standard deviations above its long run norm of 1.9 is not a level to chase. Dig into this is, and then you go into your research, which we will push afterwards. Are you worried a little bit that the equity markets, and this is the age-old question, are getting ahead of themselves again with all this?
Well, I think that they are. I put out a report shortly after the war with Iran started, where I said that if you go back to like the 9 wars since World War II, the day the war ends, the S&P 500 is up in the next 12 months 100% of the time, and the average increase and the median was around 20%. And here the war's not even over. I guess the worst of the hostilities are over, but certainly what should matter most for the markets was not so much the bombing campaign taking place in Iran, but really the closure of the Strait of Hormuz, and that hasn't been resolved. And here the market is up 12%, and Nasdaq's already pretty well done what the whole stock market normally does a year after the war is over.
It's incredible.
So that's a real anomaly. So yeah, but again, you could argue, as some technical strategists will say, well, the cumulative AD line has really improved, so on and so forth. So there's been a rising tide lifting all the boats. But the reality is that most of this rally has really just been the resurrection of the AI trade.
Mm.
So whether it's the hyperscalers or the chip stocks, they've been accounting for most of this rally. My skepticism comes from the fact that where are the financials? Now, the
Right.
financials had a small bounce, but they're technically still in correction mode. And I never, ever, in my 40 years in the business, have ever trusted a market rally of any magnitude or duration where the financials are not more than fully participating, and they've lagged behind. And that's telling you something too. I mean, there's other shocks taking place. Donald Trump is not giving up on the tariff file, despite the Supreme Court decision.
Sure.
The problems with private credit, private equity, which had been a primary source of financing companies that couldn't get funding from the banks. I mean, that's starting to get choked off. There's other things going on at the same time. But yeah, I would tend to agree with you that this is the stock market, right? And the stock
Mm.
market is often driven by animal spirits and speculation. Do I think this rally is overdone? 100%.
But yeah, as we've seen in the past, they trying to fight a rally of this sort of magnitude has not gone well for anyone in for the last I'd argue 10 years. I want to we're coming to the end, near the end now, in the beginning, and I want to look towards the future, in the sense that we are now seeing the end of an era with Fed Chair Powell. There, obviously there was some, I guess, not confusion, but potentially he could stay on as one of the board members. But Kevin Walsh has been through his Senate hearing now, and any opposition to his appointment, I think, is fairly dissipated. So he is likely to take his seat. It may sometime, all things being likely. What do you think? And I'll come to you again, Mike, first. Sorry, David first. What do you think how much of a reformist do you think he will be? Do you think he's going to come in and completely stand everything on its head and be that shill that people worry that he might be as a Trump nominee? Bearing in mind that Powell was a Trump nominee when he came to power, or do you think that Fed hat will pervade and he will do what's best for the Fed ultimately? I know it's a poison chalice of a question, but I'll give you a crack at it.
Yeah, well, I think that Warsh made it very clear that he was going to do all he could to preserve the independence of the central bank. I think this view that he is soft on inflation, I think, is probably misplaced. He has been an inflation hawk his whole life. Um,
And
how it,
that's been borne out in his past term as a Fed board member and the voting pattern that he's had in the past. So yeah, I mean, people should take
yeah, I don't view, he might want to trim rates a couple of times. I don't think he's going to do it immediately because circumstances have changed. And we have to keep in mind that he might have the most powerful vote, but on the FOMC voting committee, he's got one vote. It's one vote. He's got a whole committee. And it's going to be important for him, as it is with any new central bank chairman, to cobble together consensus and really develop some credo like right away. Like he served on the Fed before, but this is a new group. So I think people should do is just fade the headlines. He is not gone soft on inflation. He is traditionally a hawk. He's going to do things differently, like most central banks do things differently. Ben Bernanke came in and did things a lot differently. Powell did as well. And in both cases, when you talk about these central banks put their mark, these chairmen put their mark on the Fed. Usually, circumstances drive them to that result. But I do think if you're going to ask me, where he'll be different, I think that he will probably be able to cobble together a consensus where there'll be less Fed speak. And I say bring that on. The Fed speaks way too much. It was Bernanke that really took the communications of the Fed to like a whole new stratospheric level. So I think you're going to find less Fed communication, not zero. We're not going back to where we were under Volcker. But I think there'll be less communication. That means there'll be less confusion. I think that he will do his best to shrink the balance sheet. So that's something that, he might want to cut rates, but offset and have that easing offset by balance sheet reduction. We know where he stands on that. And I think
Absolutely.
that the Fed's going to be quieter and the Fed's going to be smaller. I think all these, he talks about he's 100% right. The mission creep by the Fed into areas that it had no business in, whether it's climate change or ESG or DEI. He'll move away from that. I think he will probably try and ensure the central bank has less of a regulatory role and leave that with the fiscal policy makers and the Treasury and the like. So at the margins, there will be moves. In terms of monetary policy direction, once again, he's got one vote. Let's not get carried away. And the view
But he
that
does chair. He does chair. I mean, in all the history, I don't think they've gone against what the chairman has ultimately said. So he has to be diplomatic in that sense because he,
the last thing you want to face in your first set of meetings are dissents.
yeah,
That is not a good way to build credibility. So, and the bottom line is that when you understand that the Fed is an institution,
Mm.
and it's not just the Fed governors, the other district bank presidents, but also the Fed economic staff and the economic staff at the regional banks. They have a lot of influence. So, I would say that what you see isn't always what you get. People thought that Janet Yellen was going to come in when she got appointed by Obama, and she was going to be some puffball. And her
Mm.
first move in late 2015 was to raise interest rates. Janet Yellen, really? Well, that's exactly what happened. So just fade the noise, ignore the headlines, and understand what his history is. And although he says, "Well, I want to cut rates," he's not going to do that immediately. I don't see how he can under the circumstances. And the last thing I'll just leave you with is this: when you go back to the history of the Fed chairman or chairwomen when they get appointed for whatever reason, and maybe this is just a fluke of history, go back all the way to Eccles in the 30s. And in the first year, these central bank chairmen face a crisis.
Mm.
I remember the crisis at Greenspan in 1987 with the crash in October. So something is going to happen because history tells us that for whatever reason, the central bank chairman in their first 12 to 18 months faces a very serious test and crisis. So keep that in mind. It's one of the reasons why I haven't abandoned my bullish view on bonds, even though it's very unpopular right now.
Interesting. Joe, do you have anything to add to that? Do you generally agree, or you're a rates trader, you're going to be looking at this, the new Fed chairman closely and his language, and do you welcome less chatter? Does it make your job easier or harder? I know you're not a short-termist trader, short-term intraday trader necessarily, but that's where all the opportunity used to come. What do you hope for? What do you think?
Oh, yeah. So as a trader, I actually prefer more communications.
I thought so.
And yeah, and actually having more communications actually reduces the volatility in the market. And so, the Fed may or may not want more volatility in the market, but that does,
That is a good point. That there is you tend to
very much the curve does make for
you cut out there.
unruly.
What? You cut out briefly there. Sorry, if you could start it again.
Oh, sure. It does for unruly trading when you don't have more information, because it actually never that one Fed member would say one thing and then another Fed member would say another thing, because, you just kind of compartmentalize it as, this is what this person thinks, but this is what this person thinks. Because, at the end of the day, you have to just add all those little pieces together and figure out what the Fed is doing. And then in terms of Warsh's effect, I agree with David that, he's just one vote. And just the main impression I got from his confirmation hearing is that he doesn't seem to do well in diplomacy. Or isn't be the guy bring everything, in terms can.
Yeah, you're cutting in and out there, Joe. So I think we got the gist of what you're saying now. From your perspective, you think the vacuum in terms of Fed speak, or their transparency, or less transparent Fed, could leave people to interpret the market, interpret the message for themselves, as we maybe did in the old days when I first started back in the day. Right, just to really recap then, as we come to the end of this episode, we're looking for an unchanged rate to keep interest rates at between 3 and 3.5%. It's as you were, really. There may be slight changes to the language. I know a number of analysts there think we could get just a slight change into the language to bring it into a more neutral tone overall. And the press conference then, as esteemed guests have said, we could get Powell in his last press conference. I don't think he'll want to hand over a poison chalice, but could just emphasize the inflation risk a bit more, really. But as he stands, I'm looking at a Barclays piece here. They still maintain the Fed will, FOMC will hold rates until September and deliver a 25 basis point rate cut at that meeting. David said he still sees cuts in the future for the Fed, at least for the time being, as things stand. But for the here and now, with this uncertainty we have around the Gulf and the energy supply and the price of energy, they'll want to keep a steady hand at the moment and steady the message in its entirety at the moment. So there we are. I'd like to thank my guests. Apologies, Joe. I know you've had some issues with the sound today. To Joseph Choi of the Curve Advisor. David Rosenberg, thank you very much again for appearing. And listen, I've found your commentary and your input really interesting, and your perspective really interesting. So thank you very much.
Oh, thanks for having us on.
Pleasure's all mine.
Awesome. You can find David at he's the founder and president of Rosenberg Research Associates. We'll put up a link to where you can find all the research there. And the Curve Advisor, same on Substack. We'll put up the links to Joseph's blog. And so, yes, and listen, thank you very much for listening. Again, just to remind you, tomorrow's event, Wednesday, we're recording this on Tuesday. Wednesday, 1400 is when the interest rate decision is. Half hour later, we've got the press conference, 1400 Eastern summertime. So, and then half hour later, you'll get the press conference. You can listen in to livesquawk.com, take a trial, see if it's if something that will help your trading down or investing in general. And if you want to listen back to this in its entirety, you can listen back on the podcasts or on the social media platforms, and we'll put again all the labels up there for you to access today's episode. Thank you again for listening, everyone, and have a great day. LiveSquawk keeps serious market participants ahead of the news around the clock. Start your free trial at livesquawk.com. Thanks for tuning into the LiveSquawk podcast. Your edge in the market starts here. Subscribe now.